SVB's 48-hour death spiral, the fastest bank collapse in history. Silicon Valley Bank wasn't just another regional lender when it imploded in March 2023. It was the 16th largest bank in America, holding over $200 billion in assets and serving as the financial backbone for nearly half of all venture-backed startups in the United States. For 40 years, SVB had been the darling of Silicon Valley's innovation economy, funding everyone from early-stage biotechs to unicorn tech companies. The bank's Santa Clara headquarters had become a pilgrimage site for entrepreneurs seeking not just capital, but credibility. A banking relationship with SVB was like a Silicon Valley badge of honor, signaling that your startup had arrived. But in just 48 hours, from March 9th to March 10th, 2023, this financial giant would experience the most spectacular and rapid bank failure in American history, losing $42 billion in deposits and triggering a crisis that would shake the global banking system. The seeds of SVB's destruction were planted during the pandemic boom years of 2020 and 2021, when the Federal Reserve's near-zero interest rates and massive government stimulus created a gold rush mentality in Silicon Valley. Venture capital firms raised record-breaking funds, startups achieved billion-dollar valuations at breakneck speed, and money flowed like water through the tech ecosystem. SVB found itself at the center of this financial hurricane, as every successful funding round, every IPO, every acquisition meant more deposits flooding into the bank. Between 2019 and 2021, SVB's deposits exploded from $62 billion to nearly $200 billion, a growth rate that would have been cause for celebration at any other bank. But this rapid expansion contained the DNA of the bank's eventual destruction, because SVB made a catastrophic decision about what to do with all that new money. Rather than diversifying their investments or maintaining higher cash reserves, SVB's executives chose to pour the majority of these deposits into long-term government bonds and mortgage-backed securities. On paper, this seemed like a conservative strategy, the kind of safe investment that regulators love to see. SVB purchased over $90 billion worth of these securities, including $15 billion in mortgage-backed bonds that wouldn't mature for more than 10 years. The logic was simple. These were government-backed securities with virtually no default risk, and in the low-interest rate environment of 2021, they offered better returns than keeping cash on hand. But SVB's leadership made a fundamental error that would prove fatal. They failed to hedge against interest rate risk, essentially betting the bank's entire future on the assumption that rates would remain low indefinitely. When you buy a 10-year bond paying 2% interest, and interest rates subsequently rise to 5%, your bond becomes worth significantly less if you need to sell it before maturity. This is basic finance, yet SVB left themselves completely exposed to this risk across their entire portfolio. The first cracks in SVB's foundation appeared in early 2022 as the Federal Reserve began aggressively raising interest rates to combat inflation. The same zero-interest rate environment that had created the startup boom was being systematically dismantled, and the venture capital ecosystem began to contract rapidly. Startup funding rounds became scarce, IPOs virtually disappeared, and tech companies that had been burning through cash during the good times suddenly needed to tap their SVB deposits just to survive. Between the fourth quarter of 2021 and the fourth quarter of 2022, SVB lost nearly $20 billion in deposits as their tech clients withdrew funds to keep their companies afloat. Simultaneously, the bank's bond portfolio was becoming a financial nightmare. Those safe government securities that SVB had purchased were now worth billions less than their purchase price, creating what accountants call unrealized losses. By the end of 2022, SVB was sitting on approximately $15 billion in unrealized losses on their securities portfolio, a staggering sum that represented nearly half of the bank's total equity. The crisis accelerated dramatically in February 2023 when SVB announced it had sold $21 billion of its underwater securities at a massive loss of nearly $2 billion. This wasn't a voluntary portfolio adjustment. It was a desperate attempt to raise cash as deposit outflows continued to accelerate. To cover the loss and strengthen their balance sheet, SVB announced plans to raise $2.5 billion through a combination of stock and convertible bond offerings. CEO Greg Becker tried to frame this as a proactive measure, telling investors that the bank was positioning itself for future growth. But the market saw right through this corporate speak. SVB's stock price immediately plunged 24% in after-hours trading, and sophisticated investors began connecting the dots. If SVB was forced to sell securities at such massive losses and desperately needed to raise capital, what did that say about the bank's underlying financial health? The dominoes began falling on March 8, 2023, when influential venture capital firm Founders Fund, led by Peter Thiel, quietly instructed all of their portfolio companies to withdraw their money from SVB immediately. This wasn't a public announcement or a social media post. It was a private communication to their network of startups. But in the interconnected world of Silicon Valley, secrets don't stay secret for long. Within hours, other prominent VCs, including Union Square Ventures and Coatue Management, were having similar conversations with their portfolio companies. The venture capital community that had once been SVB's greatest asset was now becoming its executioner. These weren't panicked retail depositors standing in line at a bank branch. These were sophisticated financial professionals who understood exactly what SVB's situation meant and had the power to move massive amounts of money with a few clicks of their mouse. March 9, 2023, became known as Black Thursday for SVB, as the bank faced a digitally enabled bank run unlike anything in financial history. Traditional bank runs required physical presence, people literally running to bank branches to withdraw cash. But SVB's tech-savvy client base could move millions of dollars through wire transfers and digital banking platforms without ever leaving their offices. By 10 a.m. Pacific time, SVB was already seeing unprecedented withdrawal requests, but the real catastrophe began when the story hit social media. Twitter became ground zero for the panic, with influential tech personalities and venture capitalists publicly advising their followers to withdraw funds from SVB immediately. Investor Jason Calacanis tweeted to his hundreds of thousands of followers about the potential risks of keeping money at SVB. Startup founders shared screenshots of their withdrawal confirmations as badges of honor, creating a viral feedback loop that accelerated the crisis exponentially. By the end of March 9th, SVB customers had requested withdrawals of $42 billion, nearly a quarter of the bank's total deposits, in a single day. The speed of SVB's collapse can't be overstated. In traditional bank runs throughout history, even the most severe panics took weeks or months to fully destroy an institution. The 2008 financial crisis unfolded over more than a year. But SVB went from a functioning bank on March 8th to complete regulatory seizure on March 10th, just 48 hours later. On the morning of March 10th, SVB's stock opened down more than 60% before trading was halted. The bank's executives were frantically trying to find a buyer, reaching out to potential acquirers, including JP Chase and Bank of America, but there simply wasn't enough time. The digital bank run was moving faster than any human decision-making process could match. By 10:05 a.m. Pacific Time on March 10th, the California Department of Financial Protection and Innovation had seized control of Silicon Valley Bank, citing inadequate liquidity and insolvency. The Federal Deposit Insurance Corporation was appointed as receiver, and SVB officially ceased to exist as an independent entity. The human drama behind SVB's collapse reveals the interconnected nature of modern finance and the power of digital communication to transform a manageable crisis into a complete catastrophe. Greg Becker, SVB's CEO since 2011, had built his career on understanding the unique needs of the tech ecosystem. But that same expertise couldn't save him when the ecosystem turned against his bank. On March 9th, as the digital bank run accelerated, Becker held an emergency conference call with clients and investors, desperately trying to project calm and confidence. He emphasized SVB's 40-year history, their strong relationships with clients, and their fundamental commitment to the innovation economy. But his words were drowned out by the tsunami of social media panic and the cold mathematics of digital banking. Within hours of that call, Becker's 25-year banking career was effectively over, and he would later face congressional hearings and federal investigations into the bank's risk management failures. The aftermath of SVB's collapse sent shockwaves throughout the global financial system and exposed the unique vulnerabilities of modern banking in the digital age. More than 90% of SVB's deposits were above the FDIC insurance limit of $250,000, meaning that thousands of startups and tech companies faced the prospect of losing their entire operating capital overnight. The Federal Reserve, FDIC, and Treasury Department took the unprecedented step of guaranteeing all SVB deposits, even those above the insurance limit, to prevent a broader crisis in the innovation economy. This decision was controversial but necessary, as the alternative could have been the simultaneous bankruptcy of thousands of startups and a complete freeze in venture capital funding. The collapse also triggered runs on other regional banks with similar risk profiles, including Signature Bank in New York, which was also seized by regulators within days of SVB's failure. Credit Suisse, already weakened by years of scandals and poor risk management, suffered a crisis of confidence that led to its emergency acquisition by UBS just weeks later. The 48-hour death spiral of Silicon Valley Bank had demonstrated that in an era of digital banking and social media, even the most established financial institutions could be destroyed with unprecedented speed, fundamentally changing how regulators, bankers, and investors think about systemic risk in the modern economy.